Welcome to the Broken Pie Chart Podcast, episode 285. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, back by popular demand, Jay Pestrichelli. Jay, before we do this, I think I should play this first. Hang on. Okay. Is that good? A little breaking news?
That was it, little breaking news. And it took the market to bring me back, Derek. Like, this is it.
It did. We weren't supposed to be on together this week, but we've had some requests. And I play that, by the way, because it's all right. I think we have to sort of take a step back. We have to, people want to know our thoughts on what just went on and what's going on, but it's, I don't know. All right, let me start here. Obviously, the market was down. The market was down 3%. You know, the Monday. The Monday was the big day when the fear came in. The VIX spiked to over 60. And now the VIX wasn't around 1987, but you go back, it kind of goes back to the beginning of 92. The high price on the VIX, this is the third highest price ever on the VIX. Now, again, 87, and there's been studies done on this, it might have gone to like 189 or 200, but we had a spike above 90 in 2008. We had a spike above 80 in 2020. I will tell you though, and I'll make the argument, this is like a fire drill where people are like, they're doing a drill and they're like, okay, everybody know where to go. Okay, little Johnny, you go in here. Okay, you go up the stairs. All right, everybody, let's go. VIX is like, all right, I'm going up. I'm going to 60. High yield's like, what are you doing? Like,
all right. Before you get to the high yield part, which you're right, real underlying risk is
like, I don't think the VIX should have gone as high as that.
No, well, that's it. I think you're not that you're burying the lead, but I want to reinforce this point. This is the third highest level the VIX has ever hit. Really? You telling me since they've been tracking this, this is the third scariest market we've ever seen after the pandemic and after the Great Recession? Like, this doesn't even come close to those levels of fear. So internally, we've talked a lot about this. Felt a lot like an overreaction of the VIX. And by the end of that day, by the end of Monday, when it peaked over 65, I think it closed at 37, 38, 39, which, okay, that feels a little more digestible considering the magnitude of the move. But, I don't know about you, but I was watching the futures that morning and I saw, 1 point down 4.8%. But still, this was kind of I'm not going to say manufactured. It is what it is, and people getting squeezed out of a carry trade, which I know we'll go into. But yes, this was a volatility overreaction, and what we're seeing in the movement of the market since that day has been, yes, higher movements, but not to the point where you're estimating 4%, 5% moves per day, right? A VIX of 60 is like you're really like 4% moves per day is what's expected. And that's, we haven't seen 4% moves since that day or actually at any other point. So, I think we would both say little overreaction in the VIX, little overreaction in the volatility market to this. Naysayers, Derek, might come in and say, well, this is due to the zero DTE option craze, right? And that's what pushed all of the, that's what pushed the VIX up. I have two arguments against that, or at least one really strong one. Derek, you want to comment first? I know I'm throwing you a curveball there, but was it zero DTE options that caused the VIX to spike over 60?
I don't think so. I don't think that's the reason why there were, and we've seen things before where there were 1 or 2 or 0 days until expiration when calamity or different things happen. I have I'll let you finish that point. I'll throw it out there though. I covered what the carry trade is last week, so I'll put a link to the show notes. We don't have to go through the minutiae of that. But the fact that the carry trade blew up, doesn't that mean if you have a value at risk, you've got to add more protection to your book? Was this a function of not zero DTE, but knowing that, the market makers knowing that big institutions are going to have to come for out of the money protection to lower their value at risk. And they're like, oh yeah, step into my office. Yeah, the hurricane's off the coast. You want insurance? I don't know.
Yeah, I don't even. So one of the things that I don't know if everybody realizes, the VIX can move without a single option trading. And you may say, some may say, not you, Derek, you know this, but some may say, well, hold on a minute, isn't a VIX a reflection of the premium in the options? It wouldn't the only way that we know what the premium in the option is if it gets traded? And the answer is no. What can happen, and what I believe happened in this case, the VIX is a strike-weighted, date-weighted calculation. It's just a calculation. There's actually no trade that went off there. And so when you look at the way that math happens on the VIX, it could mean that the S&P dropped to a level where there happened to be a lot more options already in existence, like a high open interest strike. And what can happen in those scenarios is the VIX will go up just because the underlying S&P moved and made the calculation reflect a higher number. There's absolutely some of that when the market dropped as much as it did. Anybody that had on a hedge that was 10% out of the money, 5% out of the money, all those options increased in value without a single trade happening, just because the very nature of the movement of the underlying index. And so what happens in that scenario is the VIX pops, even though there was no trade, even though there wasn't even an S&P option, the VIX could have popped just because of the way the math works on the VIX calculation. So again, understanding it's a real nuanced piece of this. So again, that's why when we say it was a bit of an overreaction, it should have been the third largest fear event since the tracking of the VIX. Right? There's definitely been things scarier than this and more fear that has happened in the market. Yes, the market moved very quickly in reaction to what happened in Japan, but the resulting VIX ended up being more in line, in my opinion, with the way the VIX is calculated than actual trades that went off. However, Derek, there definitely could have been some folks that had to add a hedge, but we've been talking about how cheap hedging is for months. Mm-hmm. People with hedges on, all of a sudden, those hedges had value because the market dropped down to their level. I mean, it's why we put hedges on in the first place, right?
Yeah, where do we want to go here? You touched on having hedges. We could talk a little bit briefly about the benefit of the hedges and what we're seeing. I mean, the primary thing we do is hedge, buy and hedge for our clients and for advisors and their clients. We also have buffered strategies. We've been doing those for, I don't know, it feels like over 10 years now at least. But
close to it. Yep.
Close to it. And maybe we can touch on that a little bit. I do want to go back to the VIX, but if you let's say, and by the way, Derek.Moore@ZegaFinancial.com, Z is in zebra, E is in Eddie, G is in George, A is in Apple. And actually, no, Zega Investments is the better one. All right, let me start over. Derek.Moore@ZegaInvestments.com. You got to get, you spell investments on your own. You figure that out if you want to know how we hedge. Okay. So Jay, I mean, what we saw in those strategies was, although the market was going down, the underlying holdings, the things that we put in place that are hedging those holdings, and a hedge is something that goes up in value when the thing you're worried about is going down in value. And because volatility rose so much, not only do we get sort of the directional benefit there in the hedges, but the volatility component also helped there.
Yeah, and so those hedges start to show their more and more value as the decline occurs. Look, the first half of this year, I remember, how many times did we say market's up again, but we always talk about we don't know when something like this is going to happen, right? This came out of the blue, right? It was a little bit of a not great jobs number on a Friday. Bank of Japan moving interest rates 15 basis points unexpectedly, and boom, you get this, I'm going to say, technical unwind of a leveraged trade, which you already explained, that ripples its way into the rest of the market, right? And so, yeah, like these things, I don't think the underlying fundamentals of Apple or Nvidia changed in the last week, and I also don't think things like the projected interest rate changes. There was a little bit of a this is a little ironic piece. There was a little bit of a projection that the Fed may cut more because of the jobs number, and in the past the market liked that until it didn't like it. Which, by the way, Derek, you and I both said don't root for the Fed to have to cut rates because it means something's not going right. Like all those things they all kind of just, it was a confluence of those things that happened together. It's why we hedge all the time. And so, having those hedges on. So what is the result in a portfolio that's hedged? Well, when the market is down, actually top to bottom, the high of the S&P a few weeks ago to the low of Monday was just under 10%. It's amazing how often that goes to 9.5, 9.7, 9.9, and then reverses, right?
So I believe it's 8.9.
This one from top to bottom, Derek, I actually think on the SPX was more like just over 9. I actually think it was over 8. So, but I could be wrong. You never know. Somebody's right on that math. I don't know, one of us. But my point is, when that occurs, your portfolio doesn't experience all of that drop because your hedges are going up. And of course, it depends when everybody's hedges on and all those kinds of pieces. But that's the way that dynamic works. That it ends up buffering or I'll say almost like a shock absorber as to the amount of loss that you'll see in your portfolio on that day. I'm not sure how many people looked in their accounts that day. I know we had a lot of clients that looked and didn't seem to worry very much, right? So it's just exactly why you have those things on, because you don't know when this is going to occur. And if you're a hedger, you actually would have liked it to be a little bit of a bigger drop. Ultimately, you don't want that, but you could have been a little more opportunistic. And we talked about capitalizing on hedges on our investment committee call that morning. And we decided wasn't enough yet to put any cash in our pocket. We'd rather keep the protection on.
Yeah, no, that's right. And I think, by the way, minus 8.45% to the close on the 5th, which was Monday, from the high on the 16th. But yeah, I mean, at one point, it was worse than that. So yeah, probably a little under 10, which isn't even in.
I show 51.19 is the low, right?
Yeah. So the other thing that we saw too is a blowout in the VVIX. So the VVIX, of course, is sort of the volatility on the VIX. It's looking, instead of SPX options, as the VIX looks at, it looks at VIX options at pretty high level, Jay.
Yep. Again, it's a reflection of, because the VIX moved, a lot of options that were not in the money went into the money, even if there wasn't a trade in the VIX itself or the VIX options themselves. The VVIX is going to be reflected there too. That's a more obscure index. Most people haven't heard of the VVIX, but it is measuring the volatility of the VIX itself. So, typically it ranges in the let's say 85 to 100 range. I think we saw 160 on it, right? Again, just an exaggerated move to see that happen as a result of am I really seeing a 190 high on the VVIX?
I'm bringing it up right now because they're, 192.69.
Yeah. Yep. So closed at 173. So again, that would be a very uncommon level to have in the VVIX.
No, I mean, and if the VIX is that high, you figure the VVIX goes there too. I mean, and like you said, even if trades didn't go off, if you are a market maker and you have volatility and you're saying, oh, I might have customers that want to buy or sell VIX options, then maybe I'm going to demand a higher price given the expected volatility on those. So yeah, of course. You're going to see that.
All related.
But it's high.
We and I don't know if you want to get to this, but we like to use the VVIX as kind of an indicator that things might be kind of overblown, right? Or things might be settled for a long, long time. Mm-hmm. I don't know if you want to get into this just yet, but one of the things that we look at when we're trying to in some of our season and some of our models that are more tactical, like our 4 seasons model, we would then use this as kind of an indicator at certain levels that, hey, this is a time to, if you wanted to add money or try to find out if the market has bottomed out, this is not, this may be one indicator that you could use to decide if it's time to buy or not, right? And in one of our models, we actually had that tickle. We actually had, I think 3-4 kind of triggers fire from and said, look, this is overblown. This would be an opportunity to buy.
Thinking about VVIX too, this is the 4th highest spike ever on VVIX. Excuse me. The other ones, not surprisingly, in March of 2020, in let's see, February of 18.
We know what that one is.
We know what that one. And this leads me to the question, what does this remind us of? 824 of 15, Jay. 212-22.
All right. Well, we could talk about 2015, August of 2015. For those of you that have been with us for a while, you may or may not remember that period of time. It was a bad Thursday, an ugly Friday, and over the weekend, this is back in 2015, China devalued its currency, turned out to be a really ugly Monday, right? And this, again, foreign currency impact rippling into U.S. markets. This, time that we're experiencing now in 2024 feels very much like that August of 2015 period. And it's actually been kind of the playbook we've been following to watch the movements intraday or, day to day, and what to expect here, within the shorter term. It's not like we make a lot of trades there, but there's a handful of strategies that may or may not need adjustments during the times of high volatility. So we looked at the 2015 to define our playbook on how we've been trading the last 4 days. So far, it looks fairly similar. The one caveat that I will point out about 2015 was, while you had this initial dip, big sell-off, market recovers fairly quickly over the next 2 to 3 weeks, but eventually retests the low of August in September. So, if we were to play this playbook out, right, you would say, okay, in the short term, you've seen the bottom, but you probably have to retest it to confirm it is a bottom in a month. That may or may not happen. Strangely enough, it's happening in August. Strangely enough, the bottom occurs in September of 2015, which, by the way, historically, September 2015 is the worst month on average per year. We've talked about that as well. So kind of conflicting signals, whether, you use history to say, okay, maybe the worst is in for this week, next week, but we should probably expect a retest of that bottom that we saw on Monday. That's for the bear side. On the bull side of things, we would say, yeah, but if you're going to be a buyer, this is volatility. Some volatility indicators have told you that 20 days, 30 days, 60 days forward, the market is generally higher from where it is now. So you have the buy and sell argument right there in the data points for you to choose from.
I mean, I saw, I don't have it in front of me, but somebody published a scatter plot of, the XY axis of the x-axis on the left side was what the market was up 5 months later. I think it was 5 months later. And then you looked at the bottom was sort of the VIX. And what generally you see is when the VIX gets really high, typically that happens after sell-offs or during sell-offs. And then if market recovers, and we don't know what's going to happen going forward. But history says that when you get these types of spikes, generally the market is higher. If 3, 4, 5 months later.
Yeah. Can we maybe, you touched on it earlier and I cut you off about high yield is kind of another indicator. We've had some folks who listen regularly reach out and say, hey, what do the high yield spreads look like? Have we seen any new risks of defaults, Derek, here? Have we seen kind of a fundamental shift in the risk profile of the bond market?
We haven't. And I met with some of the State Street folks, probably a week ago, maybe a week and a half ago. And, one of the points from there is we're not seeing any, material issues in credit. And we look at what's something like the high yield spread. So the high yield spread is, what is the percent yield on high yield bonds versus, let's say, treasury bonds? And so if high yield is 8% or 8.5% or 9%, and treasuries are, and it's not just the short end. If treasuries are 4%, you would say, okay, well, you have a 4% spread, meaning you're demanding a higher yield on the high yield. What happens often when there are stress events in markets or when there's a credit event And to give you an example, one of the ones I'm looking at right now, it's 3.8%. So high yield, and it's a broad index of high yield. You're getting 3.8%, above treasuries. Jay, when I go back and I look at some of the stress events, like 2008, I mean, it was 20% above treasuries is what high yield. And what that means is, for everybody, when high yield, when the price goes down, the yield is a component of the distance to par, which is $100 on a bond. So if high yield bonds sell off, plus the coupon, that's the yield to maturity that you would get on a bond. And so when bonds get forced down lower, then their yields go up. When I look, 2008, above 20%, which is massive. When we look at 2020, it's a little tough to see on my chart, but I think they went up 10 to 11. Now, we don't have 87 is interesting. Now, there was no VIX in 87, but the high yield spread did not really move that much in 87. So maybe we can talk about that a little bit. But 2015, you look there and you say, okay, 2015, I mean, it wasn't much either. So I think you're right, Jay, when you look at high yield. And the reason why we look at high yield, if there was a real problem in the economy, you would expect those to quote unquote blow out. You would see, the declining confidence in the high yield. So, yeah, this reminds me of 2015. And by the way, I mean, there's no VIX in 87. High yield didn't blow out in 87. It's kind of interesting. I never looked at that.
Again, I didn't realize that either. But so it just goes back to the fundamentally things probably look still fine. We haven't had enough data for that. Technical reactions are always a little faster than fundamental reactions, right? Which could take a little longer. I would say that the jobs number being a little weaker on Friday could have been something that would contribute to a little bit of the, to a little fear, and that wasn't really reflected in the high yield market. I think, again, if this is really just kind of a more technical, like a little currency reset, I think that happens, right? You could have market declines. It's why, timing the market is really hard to know how to manipulate these or manage through these, right? We really don't. Like, besides the tactical model that I mentioned a minute ago with Four Seasons, generally it's not something that we do. We'd prefer to, be long and hedge, right? Just be long the market because it generally goes up, and then you're going to have wiggles like this that, while they create a lot of fear and a lot of churn, in the long run, the hope here is that this is a blip. Now, if this turns into something that is much more, was kind of the first domino to fall and a bigger sell-off because who knows, something else may occur, fine, that could be. But in and of itself, this little move here from this carry trade and the currency move, I don't think that's one of those things that, you really need to navigate day by day, right? Let this thing play out. Yes, we may have to test and reconfirm where the bottom is, which, by the way, is not a bad thing. If that happens, it happens fairly regularly. You just endure this kind of stuff, right? I think I saw an article where Warren Buffett said if a 7% move in stocks has you, I don't know the exact word he said.
Oh, yeah, I saw that.
Concerned, then you shouldn't be in stocks. And we would agree, right? But we hedge just in case it ends up being a much bigger sell-off. You never know, right?
So when I look at the markets up today, as we're recording this, what day is today? Thursday, right? Yeah, Thursday. So if I look from the close on July 16th to where we are today, and the market's up like 100 points today, the S&P. It's a strong move today. We'll see if it holds. Last couple of days, it's been up, and it's either given up some gains or went slightly negative. The total return now on the S&P, as we're talking right now, is minus 5.04%. The VIX is up close to 70%. SJNK, which is a good proxy. It's an ETF. It's based upon a high yield index, short duration high yield. It's up 0.11% since the all-time high. And by the way, the Nikkei is down 15.24%. So high yield is not necessarily, high yield has had positive non-correlation with U.S. equities. And typically, historically, I mean, I would expect 60, 70% correlation. But we're still up year to date in the markets. We're still up year to date. Now, I have no idea what's going to happen going forward. I will tell you, Jay, that I looked at the earnings estimates, and remember, we were at a 22 forward PE. I think we had gotten down close to a 20 PE. I don't know if we ever broke below that on the forward basis, but 20.75 is now the forward PE, so it's down a little bit. In theory, stocks have gotten cheaper on a forward basis. The analyst estimates call for next 12 months, 9.7% growth in earnings, 2 years, 13.38%, and 3 years out, 8.13. Again, those can all change. Analysts move their numbers around. But this doesn't seem like it's an equity thing. It doesn't seem like it's a credit thing. It just sort of happened. And I think people are more worried right now than 5%. You would think we're down 20 or 30%. Now, the market always climbs a wall of worry. Okay, we have geopolitical stuff. We have what's going on in the Middle East right now. It feels like there's always stuff going on in the Middle East. But yeah, I mean, we'll see. This is why we hedge, Jay. But I don't know. Did I round up enough on the what's going on in the markets?
Yeah, I think so. And I think we've hit on, buffering and hedging. We've hit a little bit about tactical. Why don't we, if you don't mind, talk a little bit about our strategies that sell volatility, right?
And that's so we sell, and there's a couple strategies that sell deep out of the money spreads. And the idea is to generate income from those. We've been doing this for I shouldn't say well over a decade, but it's been a while. And as you would expect, some volatility trades get pressured or, so yeah, I mean, I'll let you kind of take this one, Jay, and I'll come in after.
Yeah. So the strategies we're talking about are the high probability option strategies. We call it hypos. And these are option strategies that take advantage of the natural time decay of the market. And you could say essentially sell volatility. Well, if you're a seller of volatility and volatility moves up, that means it has moved against you, right? That means you were short vol and vol went higher. It means it's a bad position to be in. And so for the breakdown of these, our most conservative version of this strategy is when we start to see some kind of cracks in the foundation of the volatility market, we're going to be fairly conservative and move quickly. We put out a blog post about this last week on Friday. We actually ended up de-risking the position a little bit on Friday, not knowing what was going to happen Monday, but we ended up rolling out, getting farther out of the money, putting on a position that was less susceptible to more moves in volatility. We did book, a small loss on that strategy when we did that. I don't know. I think in general, what did we say, Derek? Was it 3-4%? Maybe we might have booked
right around there. Yeah.
And without, every account is different here, of course, but that's generally what happened and bought us essentially a few more weeks of time. And so then when Monday hit, that strategy, while it wasn't, thumbs up, it didn't require a more emergency type action, right? It was already in a good position and was fine. And so those positions to date have weathered the storm of that, real spike in volatility on Monday. In our aggressive and our ultra models and those other ones that will take a little more risk and not be as conservative, they ended up experiencing much wider swings and more reflective of being short volatility. Those, by the time this comes out, will have probably either got to expiration or been rolled out. Those are, much closer to their time of coming to expiration and maybe getting through it or not. Don't know how it's all going to play out, but those experience more risk. So again, it's this volatility strategy or hypos, high probability option strategy, is designed to take advantage of volatility in the market, and it sells it. And when you get an unexpected spike like this, it feels a little bit of pain from that move. However, it's still an actively managed strategy that we will look to take action where we conservatively and the conservative version or aggressive version will aggressively take kind of new positions to continue to try to weather the storm. I will add one other thing about this strategy, because you don't know when you can have a VIX pop like what we saw, or even just not even that, a VIX pop from 15 to 30 would be a big enough move to cause the strategy to feel some stress. We always tell people to manage the risk of how much they put into the strategy. So as you've heard us say many, many times before, the only thing you can actually manage is the risk you take. And so with the unknown characteristic of this kind of a strategy, it's not hedged, right? It is in the market always when the rules are met, harvesting volatility. And you don't know when you have an event like what we're going through right now. We recommend people don't exceed 20%, 10% for even people with less risk tolerance. So again, if you've managed your position properly up front, which we always talk about first, we know we do that with our clients, and then we manage through the trade. It's one of those scenarios where it won't be a stellar year for the strategy, but we live to trade another day in the strategy, and so we're hopeful that we'll be able to continue to do what it has done over history. And for more information about that strategy, definitely reach out to Derek. There's a lot more complications that go into it, but it's something that a lot of folks use us for. So I feel like it'd be remiss if we didn't talk about hypos.
Yeah, absolutely. I did have a question too. That now that volatility is higher, and I guess that's a good question too, is are we in an elevated volatility regime? My thought is for the intermediate period, yeah, it seems like it. But the question was, does that help the strategy? Yeah, potentially it does, because when volatility is higher, the idea is that we can either be further away, by further away, deeper out of the money, and still get the required, by our strict rules, the required premium and return. So, potentially it is a positive. What you don't want in these strategies, like Jay, you just mentioned, is you're at a volatility and then you see a really big spike. The other question I got too, so we run a couple strategies where we're selling, we're trying to generate higher income there on individual names. And the question came up, does this mean that potentially we could bring in higher premium within those complexes? I don't know, Jay, if you want to touch on that briefly.
I don't know. I don't know exactly what you were saying specifically. So you mean you're dancing around it a little bit.
I'm trying to stay compliant, in the some of the funds or some of
our cover call strategies.
Yeah, there you go. I'm trying. You know how it is. We start talking about certain things, then I got to put a bunch of disclaimers in, or it's a different thing.
Understood. So, thanks. I want to make sure we're on the same page here. Yeah. Look, it's strategies that generate most of the returns from selling options will have opportunity to sell more premium in a higher volatile environment. That's just the way that it goes, right? So if you've got a stock that's got 40 or 50 implied volatility and you sell options on it for 40 or 50%, that's different than when that same stock has a 90% volatility and you could sell options for 90%, 70, 80, 90%, right? So it doesn't necessarily mean the total return is any better. It just means that the option premium as a percentage of the underlying could be a little higher. So yes, I do think we should expect to see higher volatility across the board when it comes to whether it's concentrated stock or some of the funds that use individual stock. Generally, every ticker that we look at on an individual basis has higher volatility now compared to where it was last week. No question about it.
All right. I want to talk a second about employment, and I'll definitely put the link in the show notes to the episode last week, because I did cover
your employment, your job.
Should we talk about that? Do I need
You're allowed to keep your job this week.
All right, good. You too, Jay. I'll let you stay around. I appreciate that. Yeah. So I talked about the jobs data and the BLS, the Bureau of Labor Statistics, last week in detail. So I'll refer to that in the show notes. But one of the things I touched on this last week, I'm going to talk about it again. I know people keep pointing to the rise in unemployment rate. And I'll remind people that you have, the way it's calculated is you've got the size of the working population, You've got the size of the civilian non-institutional population. So everybody that could work, that's not otherwise incarcerated. And the people in the labor force are those that are working or those that are looking for work. And more people had jobs month over month, but more people came into the labor force. So look, I can be wrong about this. And maybe, this is on the precipice of a recession, and it's pretty clear, we were 3.5 in July of 23, we're 4.3 now. We went from 4 to 4.1 to 4.3. It's actually 4.25, but it's rounded up to 3. Maybe I'm just looking at this the wrong way, but I don't see a lot of people losing their jobs. I see more people coming into the labor force. Does that mean that they need money and they're coming in? And I'll say this till I'm blue in the face. I mean, it's Goldman Sachs, different firms have put out studies about the rise in immigration to the U.S. Like, that's putting more people in the labor force. So this is not new for me saying this, but maybe I'm wrong, Jay. But I don't think this is the rise in unemployment is the bad kind of rise.
Yeah, No, I agree. That was my initial reaction too when I saw the numbers. It was like, oh, more people want to go into the workforce. I actually think that's a good thing. And you're right. The longer term impact of immigration is obviously going to show its face here. So I would agree with you, Derek. I really didn't feel it was an awful report. I actually, look, the Fed is trying to cool the economy with its, what I'll say, a little more restrictive interest rate. I almost feel like they're going to get bullied into a cut in September. I don't know if it's going to be 1 or 2. We've talked about September being the time when, for optics, they may do 1 just to show that they're aware that inflation has dropped. But, I feel like the market's going to bully them in a little bit to it. It may not really be necessary. Do we get another jobs report before the next Fed meeting? I think we do, don't we?
The next, I'll try and do it on the fly.
I'll look
it's,
as well.
I'd have to, I didn't have it handy, Jay. I didn't have the number.
Listen, I love throwing you the curveballs, Derek, because you usually handle them, pretty darn well.
No, I was on the wrong screen. If you give me 1 second, because I'm going to go to employment. I have a way of doing this. So labor market, and I'm going to change my calendar out to September 30th. And let's see. So employment. Unemployment rate 9.6 is the August unemployment rate.
Yep, and the next Fed meeting is on September 18th. So we do get another report, right? So we get another one of these data points, probably be another little shakeup. Who knows how it's going to be interpreted? I'm looking, looks like 55% chance of 2 cuts. Am I reading that properly? I'm trying to figure out exactly where we are right now here.
That was the screen I was on until you made me go to this screen.
Boo.
I'll tell you right now where it is. Let me make sure, because I had Japan up earlier. So there is a 100% probability of 1 cut at the September 18th meeting, a 64.6% probability of an additional cut. Additional cut means just 2 25 basis point cuts or 50 bips. To play this out, and then you can kind of comment on this. The November meeting, 100% of 2 cuts, 88.5% of an additional cut. So 88.5%, we will have 3 cuts by then. By the end of December, basically they're saying 100% probability of 4 cuts and only a 10% probability of that additional cut. So
I love that it's 100%. So no chance, but anything but it, right? Although
until
everything
it changes.
trades as it trades, right?
Yeah, I'll change my date on this. I'll go back to July 16th, and there was maybe 2 cuts. This is. Yeah. I don't know. I will also tell you that. Let me be nice about this. There were people coming out and calling for an emergency rate cut of 100 bips, of 75 bips, of 50 bips, 0.5%. Let me just explain something to you. When you have the dollar strengthening against the yen, the very worst thing you could do was increase the probability of more cuts or doing cuts. because these are relative. And a carry trade is you're earning interest in one currency and paying interest in the other. You would reduce the spread and exacerbate the sell-off in that pair. So I don't know why. I mean, these are the same people who have just been calling for rate cuts.
Like, yeah, I mean, they've been on the wrong side of that trade for a long time, right? And they're using this as a time. Again, I mean, it looks like, we're going to get one. Whether we get bullied into two or not, I don't know. What happens if the job numbers come out in September, right? And it's like, oh, by the way, revision for last month, add 150,000, right, which, by the way, happens all the time. Yes. And then also comes in with beat the 250,000 expectation by another 100,000, and we have plus 350,000. Oh, was there actually no problem? Are we still going to get calls for the cut? It feels like, I think they'll probably cut one no matter what. Just the data is the data. A single data point, the Fed almost never reacts on a single data point. And so I wouldn't expect them to react only based on this one. The bond market certainly thinks it's going to react, though.
They're going to, so far, the Fed funds futures has not been caught offsides at the front meeting, meaning the meeting that's happening. So if you look a week out, a couple days out, the Fed funds futures have nailed what it is because they've been doing a lot of talking. And I think the next date we got to look at is, I'm just looking up, the Kansas City Fed. I don't know if you know this, the Kansas City Fed actually hosts an annual Jackson Hole Economic Policy Symposium.
Oh gosh, Jackson Hole is here. You are correct.
August 22nd to the 24th. And I got to believe there'll be microphones there and lots of talkers. So they're going to...
We've seen that. I mean, what was it? Was it 2021, right? That is where the transitory term was used for the first time?
Might be, yeah.
Yeah. Maybe it was 2020. Yeah, 2020. Look, we will hear more from the Fed, and we will see. A trade is a trade, right? Nothing's in the books until we see what happens. Still think it's not necessary yet. Economy still seems to be okay. Fine, it slows down. That was the point. The way to beat inflation is you need a little slowing of the economy. And if more people are going to work, you want to hope that the retail, retail buyers and sellers, retail folks are going to continue. The retail numbers look strong, right? So we'll see. I think we have a number on Monday. It might be retail sales. I don't remember which number that we see on Monday coming out, but I do think maybe it'll give a little indication as to, do we have strength or do we really have a problem?
Yeah, I mean, if you look at the economic releases, so what is Monday? 8-9, that's the 12th. So we've got PPI next week. We got CPI on the 14th. So that will be... Yeah, it's kind of a bigger week. Retail sales on the 15th.
Yeah, okay.
And, I will say real retail sales still has never exceeded the high of March of 21. Real. And all right, can I just give you a pet peeve? I'm not going to spend too much time on this.
Sure. Can't wait to hear it.
Let's just decide, do we use real numbers, meaning after inflation, for everything, or do we use nominal for everything? Because retail sales... the one that's on CNBC is nominal. It's not real. GDP is real GDP. All right?
Let me ask you a question.
Yeah.
Earnings, do they include inflationary numbers? They do.
Earnings are nominal. They're not real after inflation.
Yeah. There you go. So you should use nominal.
Yeah. All right. I think we beat this to death. I think the message, and I'll let you kind of share what you want to share, but my message to investors is, I think it's that you picked the Warren Buffett perfectly. It's, if you are worried about what's going on, you should have a conversation with your advisor, whether that's us or whether that's one of the advisors that we run strategies for that, they run for their clients. And make sure you're in the right stuff. The other thing I will say is that, and we see this with risk questionnaires. If you do a risk questionnaire after a sell-off, people are very reticent to take risk. They're very fearful. And then at market tops, they're like, why aren't we taking more risk? So I think it's good to just kind of take a step back, be measured. As you always say, you never make a good decision when you're panicked, worried, or, stressed out. And if you are someone that is in this for the long haul, and even not in the long haul, if you're retiring a couple of years, like this is why we sort of, and advisors do the planning with you. Let's design something that gets you hopefully what you need and takes the appropriate amount of risk. So take a step back here. It's, we don't know what's going to happen, but Jay, anything to add to that?
Sounded good. Loved it.
All right. Any recommendations? I'm catching you off guard here.
I saw Deadpool, strong, very bullish. Thought it was hilarious, but I'm a big fan of that genre. So there you go.
Strong buy.
If you haven't seen the other two, it's still worth seeing, but it's going to be even more funny if you watch the other two first, which are also very funny. So strong buy on Deadpool. Rated R though, so just don't bring your kids.
I have heard some parents be surprised. They thought it was more like the Marvel Spider-Man stuff and say, "Oh, I didn't know."
And you don't know about Deadpool.
Yeah. I will give I'm going to go, it's on my conviction list as Goldman Sachs. Doesn't Goldman Sachs use conviction list?
Does somebody still have that?
I don't know. But I'm a strong buy on Twisters, Jay. I saw that in the movie theaters with my son. Very good.
All right. 2 good movies to watch. Love it.
2 good movies. All right, Jay. We'll maybe come back next week together. We'll definitely have a show. I don't know. Remember if we were scheduled next week or not? I think that was the plan. So maybe I'll just say
you'll be back next week. I'll be back. We finally got my travel schedule under control. I'll be back.
All right, everyone. We'll come back next week and see what we got wrong, what we got right, and we'll go from there. Jay, thanks again. See you, everyone.
Thanks, sir.
Take care.